Here is a number that should genuinely bother you. Right now, Americans are carrying over $1.25 trillion in credit card debt. And the average interest rate on those cards is sitting right around 21%. Let me put that into perspective for you in a second, because that number is way worse than it sounds on the surface. But first, quick note, if you own a home and you are sitting on credit card balances that keep you up at night, there is a link in the description where you can book a call with me. No pressure, no pitch, just a real conversation about your numbers. Okay, back to it. So here is what 21% actually looks like in real life. Let's say $5,000 on a credit card. Your minimum payment comes to about $100 a month. Sounds manageable, right? Here is the part that will make your stomach turn. Of that $100, you roughly 87.50 goes straight to interest. Only $12.50 actually chips away at what you owe. You are basically running in place. And if you only make that minimum payment every single month without adding another dime to the card, it will take you over 2 decades to pay it off on a $5,000 balance. You will pay thousands and thousands of dollars in interest on top of the original amount. That is the minimum payment trap. And it is how credit card companies make their money. They are not rooting for you to pay off fast. They design the system so you pay slowly. Now, here's where it gets interesting. And honestly, this is the part that changes everything for a lot of homeowners that I work with. While Americans are drowning in $1.25 trillion of credit card debt, homeowners in this country are sitting on roughly $11 trillion in tappable home equity. Let me explain what tappable equity means, because it is a term that gets thrown around a lot. Your home equity is the difference between what your home is worth today and what you still owe on your mortgage. So, if your home is worth $400,000 and you owe $250,000, you have $150,000 in equity. Tappable equity is the portion of that you could use to borrow against while keeping a safe cushion of at least 20% equity in your home. The average homeowner right now has around $204,000 in tappable equity. And here's the wild part: 7% of that tappable equity is sitting there completely untouched. That is $1 billion doing absolutely nothing while people are paying 21% interest on their credit cards across town. Let me walk you through the three main ways you can put that equity to work, because there is actually a third option that a lot of people never even consider. I'll get to that in a moment. The first option is a home equity loan. Think of this as a second mortgage. You borrow a lump sum at a fixed interest rate and you pay it back over a set period, usually 5 to 30 years, with a consistent monthly payment. The rate on a home equity loan right now is averaging somewhere in the mid to high single digits, which is a fraction of what credit cards charge. So instead of paying 21% on 5 credit cards, you consolidate everything into one payment at a dramatically lower rate. Who is this for? If you have a specific total amount of debt you want to knock out, you want a predictable fixed payment every month, and you do not want to worry about your rate changing, a home equity loan is a strong fit. Who is it not for? If you already have a very low rate on your primary mortgage and you do not want to take on a second monthly payment, this might not be the right move for you. Now, here's the second option. And if you want help figuring out which of these fits your specific situation, book a call with me. The link is right below this video. The second option is a HELOC, which stands for Home Equity Line of Credit. This works more like a credit card, but backed by your home. You get approved for a credit line and you only borrow what you need when you need it. The rate is variable, meaning it can go up or down. But right now, HELOC rates are averaging around 7%, which is still massively lower than any credit card. The nice thing about a HELOC is flexibility. You draw money as needed, you pay it back, and the credit line is there again if something comes up. This is a great way for someone who has debt that they want to pay off, but also wants to access a revolving line for future needs, like a home repair or an emergency. It's not ideal for someone who is not disciplined with credit because having an open line of credit that you can draw from over and over creates risk that could run up new debt on top of the old debt. Be honest with yourself about that. Okay. Here's the third option. And this is the one that catches a lot of people off guard. It is a cash out refinance. With this, you replace your existing mortgage with a brand new, larger mortgage and take the difference in cash. So, if you owe $200,000 on a $400,000 home, you might refinance to $280,000 and take $80,000 in cash to pay off your credit cards. You end up with one single mortgage payment, no second loan, no separate line of credit, just one payment. I had a client a few months ago who came to me with about $30,000 spread across 4 credit cards. She was paying over $600 a month in minimum payments and barely making a dent. We looked at her equity, ran the numbers, and she was able to roll that entire $30,000 into a cash out refinance. Her total monthly obligation actually went down. And instead of 4 separate bills with 4 different due dates and 4 interest rates north of 20%, she had one predictable payment. She called me a month later and said it felt like she could finally breathe. That is what this can do when the numbers line up. But I need to be honest with you about something because this is not the right move for everyone. When you use your home equity to pay off credit card debt, you are converting unsecured debt into secured debt. That means your home is now on the line. If you cannot make the payments on your home equity loan, your HELOC or new refinanced mortgage, you could face foreclosure. Credit card debt is stressful, but nobody can take your house over it. Once you move that debt onto your home, the stakes change. So here's my honest advice. If you are going to do this, you need to also fix the habits that created the credit card debt in the first place. If you consolidate $30,000 in cards and then spend the next 2 years running those cards back up, you are in a worse position than you were when you started. This only works if it comes with a real plan to change your spending patterns. Now, let me give you 3 concrete steps you can take right now, even before you talk to anyone. Step 1, pull up your last credit card statement for every card you have. Write down the balance, the interest rate, and the minimum payment for each one. Add up the total balance and the total monthly minimums. That gives you your starting point. Step 2, look up your home's estimated value. You can use Zillow, Redfin, or your county assessor's website. Subtract what you still owe on your mortgage. That rough number is your estimated equity. If it is more than 20% of your home's value, you likely have tappable equity to work with. Step 3, compare those two numbers. If your tappable equity is significantly larger than your total credit card debt, your income comfortably supports a new payment structure, you are probably a strong candidate for one of these three options. Write those numbers down and bring them to a conversation with a mortgage professional. If you want help putting all this together for your specific situation, book a call with me. The link is in the description. And if this video helped you see your situation a little differently, hit subscribe so you catch the next one. I break down topics like this every week so you can make the smarter money moves with your home.